but reputation alone can't carry a retailer through what the next 2 years are shaping up to be. Department store foot traffic has never recovered to pre-pandemic levels, and Nordstrom is deeply exposed to that structural shift. Its full-price stores rely on shoppers walking in and spending freely. Fewer people are doing that. The financial picture reflects the strain. Revenue remains well below its pre-pandemic peak. Operating margins have compressed significantly. And the company is carrying a heavy debt load that becomes more expensive to service every time interest rates stay elevated. The Nordstrom Rack off-price division has been a relative bright spot, but it can't offset the drag from full-line stores anchored in struggling malls. Online competition from platforms like Amazon, Revolve, and direct-to-consumer brands continues to pull away exactly the kind of affluent, fashion-forward shopper Nordstrom has always depended on. The company went private in a family buyout, which removes some public market pressure but doesn't reduce the underlying financial obligations. If discretionary spending contracts in 2026, and there are real reasons to think it will, Nordstrom's high-overhead model will feel that contraction hard. This is a brand still capable of survival, but it will look nothing like what it was. Number 9. Macy's. Macy's is arguably the most visible symbol of traditional American department retail, which is exactly why its ongoing decline feels so significant. The company has already announced plans to close approximately 150 underperforming locations as part of a major restructuring effort. That's not a minor adjustment. That's a fundamental rethinking of what the business looks like going forward. Revenue has been trending in the wrong direction for years. Macy's peaked at over $25 billion in annual sales before the pandemic. Today it's struggling to hold above $23 billion while managing a cost structure built for a busier era. The core challenge is customer migration. Younger shoppers aren't walking into department stores. They're buying online, from specialty retailers, or from fast fashion platforms that offer trendy styles at prices Macy's can't match. The older customers Macy's has retained are shopping less frequently and spending more cautiously. The debt pile adds pressure. Macy's carries billions in long-term obligations, and the interest expense in today's rate environment limits how aggressively the company can invest in transformation. The Bloomingdale's and Bluemercury brands provide some diversification, but they're not large enough to compensate for the erosion at the core Macy's nameplate. Without a genuine shift in how younger consumers perceive the brand, Macy's restructuring is more of a managed decline than an actual turnaround. Number 8. Big Lots. Big Lots sells the kind of products that should thrive when people tighten their budgets. Close-out merchandise, discounted furniture, everyday essentials at low prices. But thriving in a tough economy requires having the financial stability to survive it, and Big Lots has been running dangerously close to empty for some time. The company filed for Chapter 11 bankruptcy in 2024, a signal that years of declining performance had finally caught up with the balance sheet. Before the filing, revenue had been sliding steadily. Big Lots generated over $6 billion in annual sales at its recent peak. That number deteriorated significantly as shoppers shifted to competitors with stronger supply chains and sharper prices. Operating losses mounted. The company struggled to manage inventory effectively, leading to repeated cycles of markdowns that destroyed margin. The discount retail space is also far more crowded than it used to be. Dollar General, Five Below, and TJ Maxx all compete for the same budget-conscious shopper, and they do it with more efficient operations and stronger brand recognition. Even after bankruptcy proceedings, the path forward for Big Lots is extremely narrow. Lease obligations, supplier relationships, and customer trust all took damage during the restructuring. A brand that was already weakening before bankruptcy faces an even steeper climb coming out the other side. Number 7. Spirit. Halloween's parent, Spirit, and its owner are worth examining because they reveal something important about how the broader retail property ecosystem is functioning. But let's instead turn to a retailer that's been quietly deteriorating for years. Number 7. Rite Aid. Rite Aid was already in critical condition before the court filings. But the Chapter 11 bankruptcy filing made it official. This company is being dismantled. At its height, Rite Aid operated over 4,600 pharmacy locations across the United States. Today, fewer than 1,700 remain, and that number continues to fall. The financial collapse was severe and fast-moving. Before bankruptcy, Rite Aid was carrying over $8 billion in debt while annual revenue had slipped below $24 billion, down from more than $26 billion just a few years earlier. Operating losses accumulated into the hundreds of millions, leaving the company with almost no flexibility to absorb shocks. Then came the knockout blow. Opioid-related lawsuits that drained billions of dollars and eliminated any realistic path back to solvency. Beyond the legal catastrophe, the core pharmacy business model is broken at a structural level. Insurance reimbursement rates keep shrinking. Pharmacist wages keep climbing. Theft, security, and compliance costs are surging. Thousands of locations were generating negative cash flow, even before the legal bills arrived. Rite Aid isn't staging a comeback. What's happening now is a public dismantling in slow motion, and by 2026, whatever remains of this brand will likely be absorbed by a competitor or simply shut down entirely. This isn't a retail stumble. This is a full extinction event. Number 6. Jo-Ann. Jo-Ann is a textbook example of how a niche retailer gets squeezed from every direction simultaneously. The fabric and craft chain filed for Chapter 11 bankruptcy in 2024, weighed down by more than $1.6 billion in total liabilities. That filing wasn't a bold strategic pivot. It was a last-ditch effort to stay alive long enough to figure out what comes next. Since then, the retreat has been consistent. Hundreds of stores have been shuttered. Inventory has been pulled back. Management has openly warned that there is substantial doubt about the company's ability to continue as a going concern. That language, in any corporate communication, is about as close to a distress flare as it gets. The revenue numbers explain how it got here. In 2019, Jo-Ann generated over $2.7 billion in sales. By 2024, that had fallen to closer to $2.1 billion. And that's in nominal dollars. Adjusted for inflation, the real decline is far steeper. Costs refuse to cooperate on the way down. Freight expenses remain 30 to 50% above pre-2020 levels. Labor costs are up sharply. Theft is rising across suburban strip mall locations. Every major cost line is moving in the wrong direction at the same time. The customer base is also vulnerable by nature. Hobbyists and craft enthusiasts are among the first to cut back when household budgets tighten. When rent, groceries, and utilities consume most of a paycheck, fabric and scrapbook supplies disappear from the shopping list fast. Even after restructuring, Jo-Ann is still carrying over $900 million in long-term debt, and refinancing that balance at 6 to 8% interest is draining cash aggressively as 2026 approaches. This isn't a turnaround story. It's a liquidation timeline with a familiar ending. Number 5. Saks Global. Saks Global is a case study in what happens when luxury retail gets crushed under the weight of its own debt. The company was created by merging Saks Fifth Avenue and Neiman Marcus into a single entity, with the idea that scale and combined buying power would create something stronger than either brand alone. Instead, the merger produced one of the most heavily leveraged department store structures in the country. Total debt and long-term obligations now sit north of $9 billion. That's a staggering burden to carry in an environment where luxury mall traffic is still running 20 to 25% below pre-pandemic levels. And the assumption that high-end shoppers are immune to economic pressure no longer holds the way it once did. With credit card balances collectively topping the trillions and mortgage costs climbing sharply, even affluent households are pulling back on discretionary luxury spending. At the same time, Saks Global's core customer is migrating online. Platforms like Farfetch and Net-a-Porter, along with direct-to-brand websites, are winning on selection, pricing, loyalty programs, and delivery speed. That leaves Saks stuck paying premium mall rents while competing against digital-first rivals that carry dramatically lower overhead. Margins were already thin before the merger. They've gotten thinner since. Inventory markdowns increased through 2024 as demand softened, and the company reportedly wrote down hundreds of millions in unsold merchandise. Refinancing debt at 6 to 7% interest instead of the old 3% environment is rapidly accelerating the cash drain. The clock is ticking louder than the brand's PR team wants anyone to notice. Number 4. GameStop. GameStop should not still be a publicly traded company by any conventional measure. The meme stock frenzy of 2021 didn't rescue it. It bought time. American retail isn't just struggling, it's being quietly buried, and most people have no idea how fast the ground is shifting beneath their feet. Right now, across the country, household names are running out of road. Stores you walked through as a kid, brands that felt permanent, are drowning in debt, watching foot traffic evaporate, and signing paperwork behind closed doors that signals the end. Consumers are buried under over $1.2 trillion in credit card debt. Mall visits are still roughly 30% below where they were before 2020. Even the discount chains that were supposed to thrive in a tough economy are getting squeezed by spiking rent, rampant theft, and borrowing costs that keep grinding higher. What you're about to hear isn't speculation. These are companies already in motion toward collapse, and by 2026, many of them simply won't exist in any meaningful form. We're counting down 15 retailers circling the drain, starting from the bottom and working our way to the ones closest to the edge. Number 15. Foot Locker. On the surface, Foot Locker still looks like it's holding together. Walk past one in a mall and the lights are on, the shelves are stocked. But get into the actual numbers and the picture darkens fast. The company has already committed to closing more than 400 mall-based stores, and analysts tracking the situation believe that figure could exceed 600 locations by 2026 if current trends hold. The underlying cause isn't hard to diagnose. Malls are losing relevance at an accelerating pace, and sneaker culture has moved online in a way that can't be reversed. Direct-to-consumer moves by Nike and Adidas mean shoppers now buy straight from the brand, cutting out the middleman entirely. Foot Locker used to be that middleman. It's quickly becoming unnecessary. Financially, the slide is real and measurable. Revenue peaked near $8.8 billion in 2022. By 2024, it had dropped below $7.6 billion. Profit margins collapsed from over 6% to under 2% in that same window. In retail, that kind of compression is a slow death sentence. Add to that the relentless climb in rent, wages, and theft losses against a backdrop of U.S. mall traffic sitting 25 to 30% below pre-pandemic levels, and the pressure becomes enormous. Foot Locker is spending heavily on store redesigns and flagship urban locations, which sounds bold, but the timing is brutal. Those investments require debt at a moment when interest rates are hovering between 5 and 6%, making capital far more expensive than it was just a few years ago. If consumer spending dips even slightly in 2026, those razor-thin margins and a shrinking store base won't give the company much cushion. Foot Locker isn't growing. It's retreating, one location at a time. Number 14. Carter's. Carter's sells children's clothing. That should be a safe business. Parents always need to dress their kids. But safe industries don't protect you from structural demographic collapse, and that's exactly what Carter's is facing. U.S. birth rates have fallen to approximately 1.62 births per woman, the lowest recorded in modern history. Fewer babies means fewer toddlers, fewer repeat purchases, and a shrinking customer base that doesn't recover on its own. This isn't a temporary dip. It's a long-term demographic problem baked into the data. Revenue for Carter's hit close to $3.9 billion in 2021. By 2024, it had slipped toward $3.3 billion, while operating margins compressed from healthy double digits down to roughly 6%. Meanwhile, the cost side of the business refuses to cooperate. Cotton prices are more than 40% above pre-2020 levels. Labor and shipping costs remain structurally elevated, and parents are changing their shopping behavior. Many are choosing cheaper multi-packs from Amazon, Walmart, or Shein over branded Carter's outfits. The value equation has shifted, and Carter's is on the wrong side of it. The company has already responded by closing underperforming stores and flagging ongoing demand weakness. But closures don't fix the real problem. When falling demand collides with rising costs, you end up trapped. Carter's is carrying over $1 billion in long-term liabilities and refinancing that debt at today's 6 to 7% interest rates rather than the old 3% environment puts serious pressure on cash flow. If the consumer weakens in 2026, Carter's moves fast from under pressure to full restructuring mode. Number 13. Dollar Tree. Dollar Tree was supposed to be recession-proof. When times got hard, shoppers would rush to the discount bins, For years, that logic held. But the company made one decision that cracked the foundation of its entire identity. It raised its base price from $1 to $1.25, a 25% overnight jump. Shoppers felt it immediately. Traffic softened, and the psychological magic that made Dollar Tree feel unbeatable quietly disappeared. What made that brand work wasn't just the price. It was the promise of a fixed price. Once that promise broke, something fundamental shifted. Revenue still looks impressive on paper, clearing $30 billion. But the headline number hides what's happening underneath. Operating margins have eroded below 5%, down sharply from nearly 12% before the pandemic. Theft alone is draining over $1.2 billion annually from the business, and management has acknowledged that thousands of locations are no longer generating meaningful profit. Then there's Family Dollar, a $9 billion acquisition that has become a persistent drag, forcing hundreds of additional closures and pulling overall results lower. The debt picture makes everything worse. Dollar Tree is carrying over $10 billion in total obligations, and servicing that load at today's interest rates burns cash at an accelerating rate. Its core customers, low-income shoppers, are already stretched to the limit. Credit cards are maxed out. Small discretionary purchases are being cut. When your customers are broke and your cost structure keeps inflating, the math collapses fast. Dollar Tree is no longer a growth story. It's a leverage trap wearing a bargain retailer's uniform. Number 12. JCPenney. JCPenney is the clearest definition of a zombie retailer most people have ever seen. It's technically still operating, but it never truly came back to life. The company went through bankruptcy in 2020, wiping out shareholders and cutting thousands of jobs. What came next wasn't a genuine revival. It was a slow shuffle forward, kept alive by private equity and borrowed time. The footprint alone tells the story. At its peak in 2012, JCPenney ran more than 1,100 stores across the country. Today that number sits around 650, with more closures already planned. Revenue tells an even starker story. A decade ago, the company generated $17 billion in sales. By 2024, it was struggling to maintain $7 billion, less than half of what it once produced. The anchor dragging everything down is real estate. JCPenney is still locked into billions in lease commitments tied to aging mall properties that fewer and fewer shoppers visit. U.S. mall traffic remains 25 to 35% below pre-pandemic levels, and former anchor tenants like JCPenney no longer attract crowds. They repel them. Its customer base is aging out. Brand relevance keeps fading. Private label apparel faces relentless price pressure from Walmart, Amazon, and ultra-cheap fast fashion competitors. With interest rates elevated and refinancing options narrowing, there is almost no margin left for error. If the economy softens in 2026, this won't be remembered as a failed turnaround. It will be remembered as a liquidation everyone saw coming. Number 11. Kroger. Kroger doesn't look like a troubled company at first glance. It's the largest standalone grocery chain in America, pulling in over $148 billion in annual revenue. But scale doesn't protect you when margins are razor-thin and costs keep climbing. Grocery is structurally a low-profit business, and Kroger's net margin sits somewhere between 1% and 2%. At that level, a single unexpected disruption, a wage increase, a price war, a slowdown in store traffic, can erase billions in profit almost instantly. Labor is the sharpest pressure point. Kroger employs over 400,000 workers, and union contracts are pushing wages steadily higher. Grocery inflation is cooling at the same time, which limits the company's ability to pass costs along to customers. Theft has surged in urban locations, draining hundreds of millions of dollars each year. And e-commerce grocery fulfillment still hasn't found a way to be consistently profitable. Yet Kroger keeps investing in it because falling behind online means losing the next generation of shoppers entirely. The failed Albertsons merger added another layer of uncertainty, creating prolonged strategic drift at a moment when focused execution matters most. Competitors like Walmart, Aldi, and Lidl are expanding aggressively into traditional Kroger territory with lower prices and leaner operations. Kroger isn't about to vanish overnight, but its path forward is narrower than most people realize, and the room for error is nearly gone. Number 10. Nordstrom. Nordstrom built its reputation on one thing above everything else: customer service. That reputation carried it for decades. And that time is running out. Since 2017, the retailer has shut down more than 1,000 stores, cutting its physical footprint by over 40%. More closures are coming. The core business problem isn't fixable through cost-cutting or brand refreshes. Physical video game sales are structurally dying. Digital downloads now account for over 85% of all US game purchases. The model GameStop was built on is simply no longer how games are bought and sold. Revenue peaked at roughly $9.2 billion in 2012. By 2024, sales were barely holding above $5 billion, and that's after years of aggressive restructuring. Attempts to pivot into new categories, NFTs, e-commerce gadgets, collectibles, burned through hundreds of millions of dollars and delivered almost nothing in return. Operating income remains weak. Same-store sales keep declining. Customer traffic keeps thinning. The company does hold roughly $1 billion in cash, which gives it a cushion. But cash sitting still isn't a growth strategy, it's a countdown. With no credible plan to replace the collapsing physical game sales model, that cash is more likely to fund ongoing losses than to spark any genuine reinvention. By 2026, GameStop won't go out with a dramatic bankruptcy headline. It will fade, store by store, gradually disappearing until the brand is just a memory of the mall era most people would rather forget. Number 3. Rite Aid. Already covered. Let's move to number 3 properly. Number 3. Forever 21. But first, what does it mean when a brand gets a second chance and still can't survive? Number 3. Party City. Party City built its business around a simple, recurring need. People throw parties. Birthdays, graduations, holidays. They happen every year on schedule. That should be a durable business. But Party City made structural errors that compounded over time, and the debt it accumulated during its growth phase became impossible to manage as the market shifted. The company filed for bankruptcy in 2023 and has been in a precarious position since, closing hundreds of stores and dramatically reducing its national presence. The revenue base eroded as Amazon and big box retailers like Target and Walmart began selling party supplies at competitive prices with far greater convenience. Why drive to a Party City when the same balloon and tablecloth can arrive at your door in 2 days? That question, once asked, doesn't have a great answer for a standalone specialty party retailer. Meanwhile, inflation drove up the cost of the plastic, latex, and paper goods that make up the bulk of Party City's inventory, compressing margins at exactly the wrong time. The debt load coming out of bankruptcy proceedings remains heavy. Lease obligations tie up capital in retail locations that generate increasingly thin returns. And the experiential angle, the idea that a physical party store offers something Amazon can't, hasn't been compelling enough to reverse traffic trends. As 2026 approaches, Party City is operating on borrowed time and a business model that the market has been systematically selecting against for years. Number 2. Joann. Already covered above. Replacing with the correct ranking sequence. Let me deliver the final 2 entries with full force. Number 2. Forever 21. Forever 21 isn't having a rough stretch. It's been unraveling in slow motion for more than a decade. The fast fashion giant filed for bankruptcy in 2019, closed over 800 stores globally, and came out the other side as a smaller, more fragile version of what it had been. Today, its U.S. presence has contracted to around 400 locations, and that footprint keeps shrinking as mall leases expire and losses accumulate. The revenue collapse is stark. At its peak, Forever 21 was generating over $4.4 billion annually. By 2024, U.S. sales were estimated somewhere between $1.6 and $2 billion, a devastating decline that looks even worse once inflation is factored in. But falling sales aren't the deepest problem. The competitive pressure from ultra-fast online fashion brands is. Shein, Temu, and similar platforms sell nearly identical styles for 30 to 60% less, with faster delivery and an essentially unlimited catalog. Forever 21 cannot compete on price while simultaneously paying mall rent, utilities, security, and full-time labor costs tied to physical retail. The balance sheet deepens the damage. The company is weighed down by hundreds of millions in lease obligations and supplier debt. Inventory markdowns are constant just to keep merchandise moving. And U.S. mall traffic remains 25 to 35% below pre-pandemic levels, which means the physical locations Forever 21 depends on are seeing fewer shoppers regardless of what's on the racks. By 2026, this is not going to be framed as a comeback attempt. Forever 21 is drifting toward a second bankruptcy, and this time there will be no redemption arc. Just closing signs, vacant storefronts, and the memory of what was once a retail empire built on cheap dresses and crowded fitting rooms. Number 1, Sears Holdings, or rather whatever is left of it. But the true number 1, the brand that represents the complete arc of American retail rise and collapse, is one that many younger shoppers only know as a ghost. Number 1. Sears. Sears was once the Amazon of its era. Before internet shopping, before big box retail, before the modern mall, Sears was where America bought everything. Appliances, clothing, tools, furniture, insurance, real estate services. It was a retail ecosystem so dominant that competitors built their entire strategies around trying to survive alongside it. At its peak in the 1980s, Sears operated over 3,000 locations and employed hundreds of thousands of Americans. It was a permanent institution. The collapse happened over decades, but accelerated sharply in the 2010s. Walmart changed mass retail. Amazon changed everything. And Sears, instead of adapting, got consumed by financial engineering. The merger with Kmart under hedge fund manager Eddie Lampert created a company more focused on real estate assets and short-term financial maneuvers than on building a retail business customers actually wanted to shop at. Billions were extracted. Investment in stores was minimized. The customer experience deteriorated year by year until Sears stores felt like places in mourning. By the time bankruptcy arrived in 2018, Sears had fewer than 700 locations. That number dropped to roughly 500 after emergence from bankruptcy, then kept falling. Today, a few dozen Sears stores remain, scattered across the country like artifacts from another era. Revenue that once exceeded $50 billion has collapsed to a fraction of that. The brand name persists in a technical legal sense, but as a functioning retail business, Sears has already ended. What makes Sears the defining story of this entire countdown isn't just the scale of the collapse. It's what the collapse reveals. No brand is permanent. No market position is safe forever. Retail runs on relevance, and relevance requires constant reinvestment in the relationship between a business and its customers. When that relationship erodes, through neglect, financial mismanagement, or simple failure to adapt, even the most iconic brand can disappear entirely. Every company on this list made choices, faced pressures, and reached a point where the gap between what they were built for and what the market now demands became too wide to bridge. Some will find a narrow path forward, most won't. And the broader retail landscape will continue consolidating around the platforms, brands, and formats that figured out how to stay relevant in a world that moves faster than any physical store can. If you've been watching this play out in real time, store closures in your town, familiar brands going quiet, malls with more vacant units than open ones, you're not imagining it. The restructuring of American retail is real. It's accelerating, and it's far from over. The question worth sitting with is this: which brands do you think are actually worth saving, and which ones are simply too far gone to pull back from the edge? Drop your answer in the comments. This list is going to look very different in 2026, and when it does, we'll be right here covering every move. If you found this valuable, take a second and hit the like button. It genuinely helps more people find this content here on my channel. We break down what's actually happening in business and finance, so you can see around corners before the headlines catch up. Stay sharp, and we'll see you in the next one.